Altman's ZETA score and Dudley in our PRESEEN case study, they have one thing in common. While Altman's ZETA score is basically a financial model for use in a manufacturing organization, Dudley actually is a manufacturing outfit. So it is important for us to guide ourselves along this path too as we prepare for our case study examination. I hope you agree with me. In this video, we are going to introduce ourselves to what Altman's Z score, popularly called, but it's Altman's ZETA score, what it means, and after that, we will take a look at some important things about it and how to calculate it, and I will go ahead also to calculate 1 year for us, year 2020. I'll try and calculate it so that we can familiarize with how to calculate others. So this is G James Associate channel. If you are just joining us, go and subscribe to G James Associate channel. We say you are welcome, and like this video and comment. If you are ready, let us start. So Altman's Z score, as popularly called, basically was for the 3 categories of manufacturing outfits. This information I will not give because of our time. We don't have time to waste and is outside the scope of this examination. But basically, things that we need to know are these. 1, it is used for credit worthiness determination of an organization and the likelihood of bankruptcy. Let me pinpoint them so that we will not forget. Please, we use it for credit worthiness determination and likelihood of bankruptcy. At least Z score could predict that an organization will be bankrupt in the next 2 years. Why are we being guided towards Altman's Z score? If you've been following, I'm going to go to our P or L now. This is the P or L. If you look at our finance costs, you will observe one thing, that it keeps increasing. It keeps increasing. It keeps increasing. So that means we are borrowing more, and when we borrow too much, there is likelihood of bankruptcy, right? So it's good that we prepare for that. Having said the objective of Z score analysis, it is important for us to know that it has some aspects to it. Fundamentally, it matches the Dudley analysis because basically it was a model for manufacturing outfits. Additionally, the Z score may not be appropriate for certain type of organization, such as rapidly growing organization and organization in which there are changes and their financial is not too structured, or the finance or the funding structure, basically for better understanding, is more or less kind of unusual. So please don't forget, once you see a bit of this likelihood in the exam, don't forget this is PRESEEN. In the unseen that you now have in the exam hall, please know what to do with it. So these are the important information that you need to lay to heart. So rapidly changing. So we can use Z score now for Dudley, because the organization's industry, cement industry, is not rapidly changing, and Z score is meant for It's a financial model for manufacturing organization, pardon me. So we move on to how to use it. How are we going to use Z-score analysis? So basically, 5 important aspects of our financial ratios are important to Z-score analysis. Number 1, our working capital, our total assets, and our retained earning. And you know, in this our particular PRESEEN question, majority of all these figures were given, except for a few of them that we may need to just compute. Majority were actually given. So Z-score will look at working capital. It will look at ratio of retained earning against total assets. It will look at earning before interest and tax against total assets. It will look at the market value of equity, and I'm going to shed more light on this, against total assets, and sales or revenue against total assets. Please, in the exams, if you try to find market value and you were not given, if you try to look for market value and you observe that you were not given, please use your net book value or total asset value that you will be given. That is if you were not given. If you are given, please don't bother use any other thing. But if you were not given, use your net asset value that you are going to be given. Okay? Having said that, each ratio that we've spoken about are combined into a single score, and the single score is this. Sorry, my pen keeps going up and down, but we'll still learn what we have to learn. So basically, this is the formula. Fantastic. Okay, we need to know this, please. We need to know this. There's no magic about it. That is the model given to us. So A now represents working capital against total assets. So A is this now, and you will put A here. That is 1.2 multiplied by A. That is the figure you are going to arrive at here. You will multiply it by this, plus the figure of ratio of retained earning against total assets. You will put it as B. Then earning before interest and tax against total assets, you will put it as C. You multiply it against 3.3. That is the standard, please. we cannot be asking Altman now how it come about 1.2, 1.4, 3.3 and the like. Please, for our preparation purpose, let's give what we need to give to Caesar, what belongs to Caesar. Okay, so market value, which I've spoken about, right? So against the total liability, you put it as D, and you put your E, sales or revenue against total asset ratio, you put it as E. We are going to demonstrate it, don't worry. We are going to demonstrate at least 1 year. Okay, so another important thing that you need to know is this. I hope we are together. Okay, like I said, we need to memorize this. We need to memorize this. We need to memorize this. Now, we need to understand this. We don't need to memorize this. but we need to understand this. Okay, and what we need to understand is that when we compute everything, it's going to give us one singular unique figure. If that figure is less than 1.81, so we need to understand this. Then it suggests the likelihood of bankruptcy of Dudley or the organization. But if it is 2.9 or equal to 3 and above 3, the likelihood of bankruptcy is very low. And if it's between 1.81 and 2.99 or 3, it is a moderate risk for bankruptcy. So those are the things, and that is what I equally highlighted here. Okay, moving on, we want to calculate now. If you've been following, we will observe that we did this yesterday, right? And we need to use some of these figures now, and we are going to measure on year 2020. Please, we are going to measure on year 2020. Now, having known what A, B, C, D, E represents, and basically these are the ratios that we need to compute, which we've been given. Now, let's go to 2020 current assets, right? And see how we determine this. We need to minus current liability from current assets. So these are liabilities, and basically we'll see that they merge everything together in this place. They merge everything together, and we need to look out for those that are current assets. Those that are current assets. So if we add these together from inventory, we add from inventory together, it's going to give us the figure we were having. We add this together. A moment, please, because of my cursor. I want to be able to highlight it for us to see. Wow. Pardon. Okay. So can we see this? So I may not be able to highlight. I think something is wrong with my cursor, but let's go through it together once and for all without it wasting our time. You will add trade receivable, prepayments, deposits, and cash together is going to give us what we have here as this. Likewise, our current liability, basically our trade payable and our dividend payable will be our current liability, because current tax liability equally, rather, because that the deferred tax, we cannot really say, we may not be able to, depending on how it moves. Likewise, employee benefits could have been a bit of longer than a year, just as we can see that it keeps increasing. Of course, long borrowing may not be for the current year. Likewise, while we do not use all these, as we can see, these are not current assets. These are non-current assets, and as per investment, if we look at it, we see that is a bit is coming from 2018, so it could not have been current assets. Basically, those are the logic behind the figure we use. I wish to be able to highlight it as I prepare for it, but the cursor is a bit, I wouldn't know. Let's move on. Okay, so that was how we arrived at this figure, and this gives us the ratio for our retained earning. All these ones are very straightforward a bit, because those figures, like this 51 now, 51 in a moment please. Retained earning, so we are going to P or L, or our balance sheet. Can we see retained earning 51? Basically, that was how we arrive at that. Then our total assets 126, total assets 126. So basically, you are just picking the remaining figures and putting them in place. So having done this, this is ZETA's score. We were coming from here, right? And we've done justice to it. Basically, this is how to go about computing ZETA score, or Altman's Z score, which is basically for the use of manufacturing outfits. If you are just joining GJM's Associate channel, please go and subscribe. Basically, this is the recap. It is used to know the credit worthiness, to determine if an organization will go bankrupt or not. For those that are just joining us, my name is Benga Olatunji, FCA from GJM's Associate channel. So we can use Altman's, because questions can come along that line that, okay, what are the objectives of Altman's Z score analysis? You give it to them. Credit worthiness, and to determine whether an organization will be bankrupt or not. What are the exceptions to its usage? We cannot use it for an organization that is in an industry that is rapidly changing, like technological environments, and also when their financial structure of funding is a bit of unusual. We cannot elaborate enough on that, but please, let's just lay that to heart. Now, how can we know that we can use Z-score, or the applicability of Z-score analysis? Is basically a model for manufacturing organization. The manufacturing organization actually has three basic categories, but it's outside the scope of the. Okay, having said that, we discuss how to calculate Altman's Z score. Basically, it has five fundamental foundations and ratios that we need to compute. We must compute ratio of working capital against total assets, retained earning against total assets, earning before interest and tax against total assets, use market value when we were given, or net available value when we were not given, against the total assets. Then the sales ratio against total assets must be used. Okay, so sales total over total assets, and having computed them all, we need to put them into the categorization of Z score analysis standard formula, which is this. We may need to memorize it, like I said. And having done that, we need to equally understand some of the grades. Some of the grades are